Patra is the Deputy Governor, particularly in charge of monetary policy and research of Reserve Bank of India. He has been a career central banker with the Reserve. He is with the Reserve Bank for over almost 25 years. He is one of the most prolific researcher in the field of both monetary policy and other macro policy making. He has a PhD from IIT Bombay. He was a postdoctoral fellow at Harvard University, and he was also at the he worked as an advisor to the International Monetary Fund. Sir, we welcome you for this special research workshop here at IIMA, and over to you, sir.
Thank you, Abhiman. Namaskar, good morning. Professor Errol D'Souza, Director, Indian Institute of Management, Ahmedabad, or IIMA. Professor Umakant Das, Director, Institute of Rural Management, Anand, or IRMA. Dr. Supriya Sharma, Partner Insights, Center for Innovation, Incubation and Entrepreneurship, or CIIE. Representatives of the Bill and Melinda Gates Foundation, BMGF, faculty, students, and staff of IIMA, and friends. I commend all of you on this laudable initiative of financial inclusion for rural transformation. It raises the bar by seeking to examine the entire value chain of financial inclusion and its effect on women empowerment with the help of research, existing and new data, and field experiments. I look forward to the findings, especially which financial inclusion products work, where, and why. I'm honored to be given the opportunity to launch this project. Drawing from what I do for a living, I thought I will share my thoughts on how financial inclusion empowers monetary policy and why people matter for its effective conduct. On a personal note, before I begin, I want to thank Professor Errol D'Souza for inviting me here. Errol and I go back a little way. Among many facets of his personality, he is also always RBI's trusted policy advisor. Errol has tried several times to get me to IIMA, and it has always been my failure to launch. But I made it finally, Errol, albeit in a virtual mode, and I do hope some of my sins are forgiven me. I also want to thank Professor Abhiman Das for his gentle perseverance through formidable odds to ensure that I heeded Errol's call. He knew exactly how to go about it, having been nurtured in the same ethos as I. A lot of what I have to say today, Abhiman, will be engraved with the nostalgia of our interactions. Financial inclusion, in the sense of access to the formal financial system for basic financial services at a reasonable cost, is now positioned as a policy objective in more than 60 countries. It is also central to the United Nations 2030 Sustainable Development Goals, or SDGs as they are known, and the G20's action plan on the 2030 agenda for sustainable development. Several direct developmental effects are attributed to financial inclusion, such as greater mobilization of savings, improving conditions for remittances, boosting fiscal revenues, and improving the effectiveness of fiscal transfers. Rather than a lever or a growth multiplier, however, it is widely viewed as enhancing the quality of growth by fostering inclusivity and by enabling other developmental goals such as poverty eradication, reduction of inequality, and women empowerment, to name a few. Given this overwhelmingly developmental focus on financial inclusion, the relationship between financial inclusion and monetary policy is obviously unfashionable. Recently, however, interest is growing on the effects of financial inclusion on the conduct of monetary policy and its contribution to human welfare through this channel. The initial conditions to spur this interest were always in existence. The United Nations Capital Development Fund, or UNCDF, reports evidence of financial inclusion contributing to stabler financial systems. Financially included economic agents appear to be able to ride out interest rate cycles pro-cyclically instead of being impacted counter-cyclically. In my remarks today, I would like to contribute to this growing interest in the symbiosis between financial inclusion and monetary policy by A, assimilating the received wisdom and empirical evidence that has been accumulated so far on the subject, and B, drawing applicable lessons therefrom for India. This assumes relevance in the context of the pandemic, during which the loss of life and livelihood impacted the financially disadvantaged and vulnerable households and businesses the most. Drawing upon its experience with financial inclusion, the RBI crafted a pandemic response that reached out in the form of unconventional measures to those afflicted sections of society by keeping finance flowing and financial institutions and markets functional, especially when personal incomes were lost and the future was highly uncertain. In this endeavor, I am emboldened by the significant milestone that the RBI has passed in its journey towards financially empowering all Indians. I refer to the construction and public release of a National Financial Inclusion Index, or FI Index, in September 2021 by the RBI. This index is based on 97 non-overlapping indicators representing access or the supply of financial inclusion infrastructure, usage or the demand for financial services, and quality or inequality in access and usage due to lack of financial literacy protection. The index takes values from 0 to 100 and implicitly sets the goal for the RBI, which is 100% financial inclusion for India. By 2021, we have passed the halfway mark, doing best in access or the supply of financial infrastructure, and lagging the most in usage or the demand to be financially included. This assumes importance from the point of view of the ambitious agenda set up by the National Strategy for Financial Inclusion, or NSFI, for the period 2019 to 24, and the National Strategy for Financial Education, NFSE, for the period 2020 to 25, in its vision of a financially literate and empowered India. There are other collateral benefits attached to the FI Index. For the first time, efforts towards expanding financial inclusion can be transparently evaluated against a publicly available and quantifiable metric. Furthermore, a measurable indicator of financial inclusion can be incorporated into monetary policy rules and reaction functions to examine its correlation with output and inflation and their variability. For the first time, the influence of financial inclusion on the size and timing of policy rate changes can be gauged. Monetary policy maximizes human welfare by minimizing the deviation of output from its potential and of inflation from the target. Although it is empirically observed that there is a two-way relationship between monetary policy and financial inclusion, it is unambiguous that financial inclusion is able to dampen inflation and output volatility. This is achieved by smoothing consumption, by enabling people to draw down financial savings or seek access to credit in difficult times for their everyday needs. In the process, it makes people interest sensitive. Moreover, inflation targeting monetary policy ensures that those at the fringe of financial inclusion are secured from adverse income shocks that hit them when prices rise unconscionably. At the cost of being slightly technical, therefore, the rest of my remarks will address 4 issues that sit at the confluence of monetary policy and financial inclusion. First, the choice of the appropriate price index as the population gets progressively included financially. Second, the impact of financial inclusion on output and inflation variability, and the trade-off between them. This is the dilemma that is central to the conduct of monetary policy. Third, the transmission of monetary policy impulses through the economy. And fourth, the impact of financial awareness on expectations and hence on the credibility of monetary policy. In the final analysis, financial inclusion fosters a societal intolerance to inflation, a social preference for macroeconomic stability, and a sense of the long and variable lags with which monetary policy operates. This makes it possible for smaller monetary policy actions to achieve the same goals in a shorter period of time than otherwise. Let me now turn to the choice of price index. What measure of inflation should monetary policy target to maximize welfare? Financial inclusion appears to be the lowest in rural, agriculture-dependent areas where food is the main source of income. Recent work in the tradition of dualistic models shows that in the presence of financial frictions, in our case, financially excluded or credit-constrained consumers existing along with those that have full access to formal finance. In such a situation, flexibly determined food prices have a critical role to play in influencing real wages and incomes of the excluded, and hence their aggregate demand. Interest rate changes do not matter so much. When food prices rise, the extra income earned by the financially excluded is not saved, but instead consumption is increased, leading to higher aggregate demand. In achieving its stabilization objective, increases by targeting a measure of prices that includes food prices rather than one that excludes them, such as core inflation. The lower the level of financial inclusion, therefore, the stronger is the case for price stability being defined in terms of headline inflation rather than any measure of core inflation that strips out food and fuel. In India, food accounts for 46% of the CPI, the Consumer Price Index. It is one among the highest shares anywhere in the world. Furthermore, the Consumer Price Index combines a rural index and an urban index, with the share of food being even higher in the rural index at 54.2%. In the urban index too, the share of food at 36.3% is sizable in a cross-country perspective. Consequently, aggregate demand is highly influenced by the behavior of food prices and farm output, rather than interest rate changes in which the urban index could be sensitive. It is in this context that the monetary policy framework overhaul that was undertaken in 2016 to usher in a flexible inflation targeting regime wisely chose the headline CPI as its metric for measuring the inflation target rather than any measure of core inflation, despite persuasive arguments for the latter that are made even today. Headline CPI has averaged 3.9% since the institution of the flexible inflation targeting regime, right up to the onset of the pandemic in March 2020. That is, during October 2016 to March 2020. With the first onslaught of COVID-19, headline inflation breached the tolerance band and averaged 6.2% in the year 2021. Strong supply-side interventions to expand access to buffer stocks and imports, to incentivize productivity, and through the lowering of taxes tamed this upsurge and aligned headline inflation again with the target this year, barring short-lived spikes in vegetable prices due to inclement weather in key vegetable producing areas. Food inflation has remained volatile throughout this period, reflecting the incidence of supply shocks on the production of items to which inflation is particularly reactive. Food inflation rose from an average of 2.9% during 2016 to 20 to 7.4% in 2021 at the height of the first wave of the pandemic. But policy interventions have managed to temper it to 3.5% in April to November 2021. Stabilizing farm incomes and food availability through the pandemic via transfers of both cash and kind has been a key policy mission. Coincidentally, financial inclusion appears to have gone up, with the level of the RBI's Financial Inclusion Index rising from 49.9 in March 2019 to 53.1 in March 2020 and further to 53.9 in March 2021. The evidence is still forming and strong conclusions from its analysis may be premature, but India's monetary policy is by design financially inclusive, and it will reap the benefits of this strategy in the future in terms of effectiveness and welfare maximization. Let me turn to the second issue, which is stabilizing output and inflation variability. As I mentioned earlier, the responsibility assigned to monetary policy is to keep output close to its potential and inflation aligned to the target. Financially included customers are able to smooth consumption in the face of shocks because of their access to savings and credit from the formal financial system. On the other hand, financially excluded consumers are not able to do so, and hence they are highly vulnerable to volatility in consumption spending and in output. An economy with all consumers financially included would expect to experience less volatility in output due to lower consumption volatility. In an economy with financially excluded consumers, on the other hand, monetary policy has to deal with higher volatility, and therefore it has to assign a higher weight to stabilizing output rather than inflation. Overarchingly, however, it is inflation volatility that affects all consumers, whether included or excluded. Therefore, minimizing inflation volatility should be the predominant objective of monetary policy in its welfare maximizing role. It follows that the larger the share of financially excluded people in an economy, the more the central bank has to pay attention to output stabilization at the cost of focusing on inflation stabilization. As financial inclusion rises, monetary policy can hone its ability to stabilize inflation and reap welfare gains for society at large. In India, the issue of financial inclusion and its role in shaping the monetary policy reaction function was recognized from the very outset while instituting the inflation targeting framework. Accordingly, price stability was assigned primacy among the goals of monetary policy, with output being a secondary objective to turn to only after price stability is achieved, defined numerically in terms of 4% CPI inflation, with a tolerance band of plus minus 2% around it. To quote from the RBI Act as amended in 2016, and I quote, "The primary objective of monetary policy is to maintain price stability while keeping in mind the objective of growth." As I pointed out earlier, this has been largely achieved, but for the exceptional experience with the pandemic. Looking ahead, inflation is expected to trend down over the next 2 years to converge to the target as pointed out in the RBI's October 2021 monetary policy report. Furthermore, there is some evidence that financial inclusion has worked in the same direction as the reforms in the monetary policy framework. The report on currency finance of the RBI for the year 2020-21 estimates that the coefficient on the deviation of inflation from the target was 0.41, that is the weight assigned to this deviation, in the period 2000 to 2011. The coefficient on the deviation of output from its potential was 0.75. That means that the RBI was assigning a higher weight to output deviations in the period 2000 to 2011 than to inflation deviations. During the period 2016 to 20, however, the period when the inflation targeting regime was in place, the weight on the inflation gap has risen to 0.70, while the weight on the output gap has fallen to 0.26, clearly revealing an increasing focus on stabilizing inflation relative to output. This has resulted in stabilizing expectations, winning foreign investor confidence, and earning credibility for the conduct of monetary policy, even as it serves financially included and excluded people of our country. Although relatively unsung, rising financial inclusion has had a significant contribution to this virtual outcome, as I just pointed out. It has been argued that as financial inclusion increases, the ratio of output volatility to inflation volatility should also rise if the central bank cares about both and sets monetary policy to optimize their trade-off. In India, this ratio has gone up from 0.6 in mid-2015 to 1.3 in the last quarter of 2021, just before the pandemic struck. Looking ahead, as financial inclusion rises even further, consumption volatility as a source of output volatility can be expected to wane, providing headroom for monetary policy to remain focused on minimizing inflation volatility, which brings welfare gains for all. Now let me turn to monetary policy transmission and financial inclusion. Modern central banks mostly employ the interest rate to convey the stance of monetary policy to the rest of the economy. Briefly put, policy rate changes immediately influence short-term money market rates, from where they are transmitted through the continuum of financial markets to longer-term interest rates, which impacts spending decisions and eventually aggregate demand. Financial inclusion is found to improve the transmission of interest-based monetary policy in two significant ways. First, the financially excluded would typically prefer inside the pillow savings. And for this, cash is the preferred instrument. As inclusion increases, their preference shifts from cash to interest-bearing bank deposits and other financial assets. Consequently, the interest sensitivity of financial savings in the economy goes up. In view of compositional changes due to interest-bearing deposits replacing currency in people's portfolios, the interest sensitivity of money balances also goes up. Second, financial inclusion is expected to expand the access to bank credit, which is interest sensitive and affected by changes in the policy rate. All in all, financial inclusion enhances the potency of interest rate-based monetary policy by causing an increasing number of people to become responsive to interest rate cycles. In turn, this prompts appropriate smoothing behavior. There is also evidence to suggest that as interest rate sensitivity of the population increases, central banks need to move interest rates by less than previously to achieve the same objectives. In India, the growing involvement of people in the monetary policy process has led to more democratic approaches to interest rate setting. The RBI has moved away from regulating interest rates during the 90s. This was followed by guideline-based loan pricing norms such as prime lending rates, base rates, marginal cost of funds-based lending rates. The goal is transparency, consumer protection, and awareness, and being as market-based as feasible, all of which are intended to foster inclusiveness. Across these regimes, transmission of policy rate changes to deposit and lending rates has improved. The process has come full circle with the establishment of external benchmark-based lending rates, which are initially applied first to retail loans and credit to micro and small units. As a consequence, transmission is even fuller. Clearly, sustaining the trust on financial inclusion will leave the RBI better off in achieving monetary policy transmission. I turn now to the role of expectations and monetary policy credibility and the way in which financial inclusion anchors it. The role of expectations is crucial to the conduct of monetary policy. People's expectations about the future are typically conditioned by the past. For instance, inflation expectations tell us about the future course of prices as people see them in the rear-view mirror. For central banks, such expectations are a crucial input for policymaking because they can crystallize into actual outcomes if the number of people sharing the same expectations gains critical mass. Furthermore, central banks can assess whether expectations are anchored or not, which has a bearing on their credibility. Therefore, what drives expectations is a question that is valuable for both people and the central banks that serve them. It is observed that financial literacy empowers people to choose more relevant information and to make better use of it. Closer assessment of future inflation helps inform choices and personal finance decisions, including opening of a bank account, taking a bank loan, or even bargaining for wages. India has recently stepped up its drive for financial inclusion to reach unserved and underserved sections of society. The JAM Trinity, Jan Dhan Yojana, Aadhaar Mobile, as it is known, is an internationally acclaimed game changer in this regard and is widely regarded as having completed inclusion in India on the deposit side. During the pandemic, the JAM Trinity was leveraged to support and save livelihoods. The NABARD's Self-Help Group Bank Linkage Program has emerged as the world's largest microfinance program in terms of number of beneficiaries and microcredit extended. The RBI, on its part, has taken a number of outreach and public awareness campaigns for financial literacy, the most visible being RBI Kehta Hai, Interactive Voice Response System or IVRS, and these initiatives have spanned all types of media. As these efforts intensify, it is expected that an included and aware population will participate more in monetary policy formulation and implementation. It will develop more rational expectations and induce financial intermediaries to transmit policy impulses more swiftly and effectively across the financial system. Let me now conclude. Monetary policy authorities typically avoid discussion on inequality. They like to be seen in a macro stabilization role and prefer leaving distributional issues to fiscal authorities. Yet increasingly, they realize that financial inclusion or the equality of access to formal finance impacts the conduct of monetary policy more fundamentally than they thought. In the choice of metric for measuring goal variables, in the choice of trade-off between their variances, and in the efficacy of monetary policy in reaching out to the broader economy. It is in this context that central banks find themselves integrally involved in policy drives to expand financial inclusion, because they have to take into account the true financial structure of the economies in which they conduct monetary policy. As people get financially included, they can use their access to formal finance to deal with both good and bad times and in more accurately assessing future inflation. And this has monetary policy implications, as I pointed out. So central banks do care about inequality. After all, social welfare, the mandate of institutions committed to the greater public good, hinges on it. Thank you very much.
Thank you, sir, for such wonderful, keynote address. It's a very difficult terrain. I think you have dealt with the complicated subject of financial inclusion along with inflation targeting and the macroeconomic world. There exists a trade-off, which you actually elucidated quite well, and quite fascinating to see the background of your chair. In true sense, you signify the macroeconomic animal spirit. So hopefully, with your keynote address, you uplift our spirit of taking this financial inclusion and rural transformation forward. Thank you very much, sir.